Hey, what's going on, guys? Welcome back to Real Estate Playbook. My name's Andrew, and today I wanted to just take some time to break down one of the common terms that's really thrown around anywhere in the real estate financing world, right? If you're looking to buy a home, refinance a home, really anything in that realm, you're going to hear all sorts of different terms, right? And if you're like me, you're kind of like, what the heck, man? Do I need to have a second degree to understand all these different terms and acronyms and abbreviations? And you know what? It kind of seems like it because there are all these different weird slang terms when you're in the lending space, more specifically the real estate lending space. And today I wanted to just take the time to break down one of those common terms just so you understand what it is, how it's used, why it's important, and ultimately how do you calculate it for your own personal situation. So today we're going to dive into what's called your loan to value, or what a lot of people just shorten it as LTV, right? And your loan to value is simply, how much financing do you need relative to the home price that you're looking to make a purchase, or even the value of your home when you're refinancing. So let's just start out here with a basic equation, because this is a ratio, and that's ultimately what lenders are using when they're classifying your loan for different risk levels. So just, basically your loan to value is the total loan amount you're going to need to bridge the gap between the down payment and the overall price of the home. So your loan amount divided by the home value, and that's going to give you a percentage, and that's what your LTV is, or your loan to value. And as you can see, I'm a pretty awesome artist, not, but I wanted to give you just a brief little diagram and example of how this works in real life. So as we've got right here, we've got your home, and I'm just using clean numbers here to kind of showcase the example. But of course, the point of this is to have you plug in your own example, and then that way you can figure out your loan to value. So for this example here, we've got a home that is listed at $100,000. That's how much it's worth. That's how much you're going to buy it for. That's what it appraised for. That's the value of the home. And in this scenario here, I've got the green shaded here showing the percent of equity you have in the home. Now, in a purchase situation, this is the down payment you're making on the home. And for this example, you are coming with a down payment of $20,000, right? You're making $20,000 towards the down payment, and that is the equity you're starting out with when you purchase this home. The remaining amount is your loan percentage, right? In this case, it would be $80,000, which is the amount that you're going to need from the bank, right? Because you need to bridge the gap between here and here of what the home is valued at. So just putting the visual into number format here, we've got the home price of $100,000. We've got your down payment of $20,000, and then we've got your loan amount of $80,000. And just plugging those numbers into our first equation here, we've got a loan amount of $80,000 divided by 100,000, because that's what the home is valued at, and that's going to equal 80%. So, long story short, this is the amount of loan you're going to need, right? And if you're looking at this in terms of down payment perspective, really your loan to value is just the inverse of the down payment. So if you make a 20% down payment, the loan to value is 80%. If you make a 10% down payment, the loan to value is 90%. If you make a 5% down payment, the loan to value is 95%. So whatever way you want to think about it, that's really what it is. Down payment and loan to value go together. This is just looking at specifically what is the loan amount that the bank is going to need to give you to finance your home. All right, so we've talked about what is your loan to value, how you calculate it, and now let's just talk about why is it important. Because it's important for a lot of reasons, because your loan to value is going to determine, how risky of a loan your loan is, right, for a bank from their perspective. And the LTV is going to affect a couple different factors. A big one, probably the most common one, is something called PMI, right? Another acronym, which stands for private mortgage insurance. So any time where you have equity of less than 20% in a home, you have to pay for what's called PMI, or private mortgage insurance. So in this situation here, you're putting down 20%. So this family, if this was you, you would not be paying for private mortgage insurance. But this is a huge factor you want to look at with your loan to value. So if you're making anywhere between 0 and 20%, if you're using one of those programs where it's a low down payment option, you're going to have mortgage insurance, right? That's a monthly payments you're going to have that's going to go into your overall monthly payment. So you want to look out for that. So if you're making anywhere less than a 20% down payment, you're going to get hit with PMI. And ultimately, your loan to value is going to affect your total loan amount, which is then going to affect your monthly payment. So if you have a bigger loan amount, you're going to have a higher monthly payment. That's just how it goes. That's just kind of how the numbers break out. Additionally, if you have PMI or private mortgage insurance, that's going to be in addition to your monthly payment. So not only if you have a higher loan amount, right, you're going to have a higher monthly payment, you also have to add this in then, which is going to make your monthly payment go up even more. So another thing you want to look at when you're looking at LTV and what yours is relative to the home that you're purchasing are the available programs that you can use. So every different lender, every different lending institution is going to have a boatload of different programs that they have access to. And all these programs are going to have different guidelines that you have to follow. One of those guidelines is going to be your loan to value. So depending on how much of a down payment you're bringing, or when you're refinancing, how much equity you have in the home, that's going to change, what programs you have available to you. So keep that in mind. And again, this is a pretty straightforward, simple equation. So you can do this on your own before you go talk to a bank or a mortgage broker or whoever it is you choose to work with, right? You can do this on your own. And then you can start inquiring about different programs, right? There's a lot of standard government programs, conventional loan options that you can, Google and figure out what the guidelines are. But, your loan to value is going to change what programs you have available. So keep that in mind when you're looking at the loan amount and ultimately what you're trying to accomplish there. So lastly, another big factor that's going to change with your loan to value is your interest rate pricing. So again, your loan to value is telling the bank how risky your loan is, right? So if you have a higher risky loan, if you have a more risky loan, I should say, you're probably going to have a higher interest rate, right? If you have a smaller loan to value, right, you're not borrowing as much money, you're likely going to be rewarded with a lower interest rate. So that's something to think about too, because obviously interest rates are the topic of discussion most commonly when it comes to financing real estate or financing for that matter. So keep that in mind, right? And this is ultimately going to affect just what's comfortable for you when it comes down to payments and just your overall financial well-being. So again, I just want to take the time to explain a common term here because sometimes it can be very overwhelming when you go talk with a bank and you just have all these different terms being thrown at you and it's just like, hold on, wait a second, slow down, explain that to me. So that was really the goal of today's video. I wanted to explain one of these common terms because no matter what category you're in when it comes to real estate and financing for that matter, you're going to hear this term, loan to value. So I hope this brought value to you. I hope this clears up some confusion when you're kind of going through the home buying process or whatever the case may be for you. So if you have any questions, feel free to drop those in the comments below. I'm happy to help answer those. Otherwise, you can email those questions to yourrealestateplaybook@gmail.com and I'll get back to you and help answer those. And again, here's the equation you need to plug in your own situation. So thank you guys for watching. I appreciate your support and I'll see you next time. Thank you.